In this segment, we are going to look at the use of the FIFO method for tracking inventory costs. The first in, first out method, which is often called the FIFO method, assumes that the first inventory purchased by the company is the first to be sold. First in, first out. To learn the application of FIFO, we will use the following information. The company is starting with 10 units at $91 a piece in their beginning inventory. They made 3 purchases during the month of August. The number of units purchased at the cost that was paid for each of those purchases. During that same period of time, a sale of 20 units sold at a price of $130 a piece, and 23 units sold at a price of $150 a piece. So let's use FIFO to account for the cost of the inventory when it is sold on those 2 dates. So recall that they began August with 10 units that had a cost of $91, starting the month of August with $910 of inventory cost on hand. On August 3rd, another $1,590 worth of inventory was purchased, bringing their inventory balance up to $2,500. After those purchases had been made, on August 14th, the company sold 20 units. To figure out what cost is going to be assigned to those units sold for recording cost of goods sold, we are going to apply the first in, first out method. So at the time of the sale, there were 2 levels of inventory available. There were 10 units and 15 unit levels. The 10 units were the first in. The 15 units were purchased after the 10 units. So to apply the FIFO method, we are going to start with the first inventory in. The first inventory in at the time of the sale had been these 10 units at a cost of $91 a piece. So we know that if we sold 20 on August 14th, 10 of them we are going to assign a cost of $91. We also have to account for the cost for the other 10 that had been sold. So we're going to go to the next first in layer using the FIFO method. That means of these 15, 10 of them were sold on August 14th at a cost of $106 each. So the total cost of goods sold on August 14th that will be recorded is the 910 plus the 1,060 or 1,970. That will leave only 5 units at a cost of $106 in inventory, or a total cost of inventory on hand after that sale of $530. After that sale, 2 more purchases were made. We had 5 at $106. We then added 20 at $115. And we added 10 at $119, bringing our total inventory available for sale up to $4,020. When we made that sale on August 31st, we are going to assume that 5 under the FIFO method were first in, first out, and they were sold at a cost of $530. We need to go to the next first in layer. After we wiped out the layer of 106, the next first in layer were 20 at 115. Of those, 18 were sold, assigning a cost of 115 to those 18, or a total cost of goods sold on August 31st of $2,600. That will leave us with $1,420 of inventory on hand, which is 2 at a cost of $115, and all 10 of these at a cost of $119, for a total inventory cost of $1,420. So we can see that the amount recorded as cost of goods sold on the income statement under the FIFO method will be the sum of those 2 cost of goods sold transactions, and the inventory reported on the balance sheet will be the ending inventory of $1,420. The journal entries using the FIFO method are not any different than they are using the specific identification method or any of the other inventory costing methods. The only thing that changes when we apply these different methods is the cost assigned to cost of goods sold. All of the other entries remain the same.